When news of a major geopolitical de-escalation flashed across global networks yesterday afternoon, the reaction seemed entirely predictable. A major ceasefire should, in theory, act as an instant relief valve. The standard playbook says equity markets climb, crude oil prices drop, and the cost of borrowing money falls as panic leaves the system. This chart shows the system's actual response. At the ceasefire, the S&P 500 dropped and crude oil spiked. The damage hit debt markets too. The 10-year Treasury, the global interest rate benchmark, climbed to 4.459%, pushing the national 30-year fixed mortgage to 6.62%. The market received the exact diplomatic victory it supposedly wanted, yet traders reacted as if an armed conflict had just intensified. This disconnect illustrates a harsh mechanical truth. Global financial markets do not simply ingest political headlines and react on command. They stress-test the text of those announcements for structural flaws. To understand why the data broke away from the narrative, we have to look past the press briefings and examine the physical infrastructure of the global economy. In institutional trading rooms, betting against a superficial, short-term headline is called fading. Fading is a strategy where traders intentionally take positions opposite to the immediate emotional market reaction because they believe the news driving it is flawed. It is the financial equivalent of a high-stakes poker game. When traders fade a geopolitical announcement, they are actively calling the bluff of an ostensibly hopeful political development. Institutional capital uses this strategy to strip away public relations spin. It forces politicians to provide concrete, verifiable evidence that a situation is actually improving. By fading this specific ceasefire headline, the bond market sent a clear mathematical warning. The underlying physical risks of the conflict remain entirely unchanged. The justification for that warning becomes obvious when you read the actual written terms of the latest de-escalation agreement. This diagram breaks down the timeline of the announcement. The market detected an immediate flaw. The document offered no permanent resolution. Instead, it pushed a planned military action, scheduled for the weekend, exactly 10 days into the future. A 10-day pause simply reschedules danger. Knowing the clock is ticking, analysts price the impending escalation right back into their models. Beyond the primary agreement, bond traders weighed a second layer of evidence derived from overnight field reports. These overnight reports tracked a steady, quiet accumulation of localized skirmishes and supply chain disruptions. These micro-escalations were happening completely outside the official scope of the main ceasefire agreement. The raw data pointed to rising tensions, while the official press release promised peace. Faced with a contradiction between underlying mathematical momentum and a surface-level political narrative, the bond market will always bet on the math. The global economy is now operating under a rigid set of rules. Financial markets have locked themselves into a highly skeptical holding pattern. Traders require physical proof of a lasting resolution, withdrawn troops or signed binding treaties. Until they see that verifiable action, their default mechanism is to fade any hopeful broadcast. This institutional skepticism has an immediate cost at the consumer level. It translates directly into the higher prices you pay at the gas pump and the elevated mortgage rates quoted by local lenders. To measure the true temperature of a global conflict, you have to mute the diplomatic press conferences and watch how the capital flows. The ultimate lie detector for international relations is not a breaking news chyron. It is the unyielding math of the 10-year Treasury yield and your daily mortgage rate.